Let's be in some exposure to Europe,
yeah.
Absolutely. And I don't think it's over, Scott. I still think there's some room to the upside in some of these names. I think specifically over in Germany, I think that EWG has been one of those trades, and I think Josh has mentioned on several occasions as well. There are some trades over there. That does not mean you look at some of the U.S.-centric, like we talked about at the top of the show when you're talking about the dollar. How about the way Target moved, and including today, new highs today, some huge rolls just last week on Friday. People have taken profits off the table to that side of it and going to the upside. So there's still spots in the U.S., but you want to be very U.S.-centric when you're there.
Well, if we've learned anything from central banks printing money is that it's great for equity values. But when you couple that with the depreciating euro, that can really take an effect on U.S. dollar-denominated investments. So if you have exposure to the dollar, which has strengthened since then, that's going to impact returns. But what you really need to look at is that the German economy is growing at about 2%. They have half the unemployment of the rest of Central Europe. They're at under 6%. So they're much like America. They're a strong economy.
Well, CVS is a defensive stock. In fact, all the stocks I'm picking for you are defensive right now. And the reason is the S&P 500's earnings are going to be down this year. I'm not sure everybody realizes that. I'm not sure everybody realizes how the strong U.S. dollar is going to crush the profits of multinationals. So what we are doing in our portfolios, we become much more domestic to try to become immune to the negative effect of a strong U.S. dollar. And CVS is just an oasis stock that I just don't think will get caught up in any market sell-off.
So you're expecting a sell-off this year then?
I'm expecting the market to have a hissy fit, for lack of a better word, because they just don't know that the earnings are going to be down because the multinationals are warning. You know, I actually own Intel, which warned, and but it has a 3.1% dividend yield. It'll hold it up.
The options market's agreeing with David's first comment, in particular about ExxonMobil and Chevron. There does not seem to be any indication in both pricing and trading that either one of these companies is expected to cut their dividend anytime this year. Looking at the options market, obviously we're looking for names that are implying a potential for a drop here. And if we would have gone back a couple of weeks ago, there are a handful of names like Ensco and Transocean that were implying pretty substantial cuts in their dividends via the options, which has obviously played out over time.